Hello and welcome to The Trade. Before we get into the technicals, a quick look at what traders are watching. And US inflation slowed more than expected in June as energy prices retreated. CPI down 0.4% over the month, the first decline since April 2020. Now, the pullback mostly reflected an almost 6% drop in energy prices. For the 12 months to June, inflation rose 3.5%, while core inflation came in softer than expected at 2.6% year on year. Meanwhile, Kevin Warsh made his first appearance before lawmakers as Fed chair, telling them that the members of the committee have no tolerance for persistently elevated inflation and that they share a resolute commitment to restoring price stability. Kevin Warsh went on to say that if they get policy right, and that they will, the inflation surge of the last 5 years will be a thing of the past. US Treasury yields fell following the CPI data, the 2-year at 4.19, the 10-year at 4.59, markets pricing in a 20% chance the Fed funds rate will be hiked by 25 basis points at the next meeting on the 29th of July. Meanwhile, there's a 70% chance, according to money markets, of a hike by September. Aussie 3-year government bond yields fell to 4.48%, 10-year 4.92%, and a quick check at where the currency market is tracking. We're seeing the Aussie at 69.8 US cents. Well, of course, markets are navigating a mix of geopolitical headlines, shifting rate expectations and upcoming earnings season. What are the charts telling us? Let's discuss with Zoran CoreCivic from Blueberry Markets, who joins me now. Great to have you with us, Zoran. Let's kick it off with the dollar, particularly what we saw in the wake of that inflation print.
Yes, thanks for having me, Julia. Quite a bearish stance in US dollar, and rightly so. Something probably the markets have actually kind of expected, to backdrop based on the CPI data that came out last night from the US, and we actually can see that, that bearish tilt towards the $100 is actually paving a way in a falling flag pattern. But the interesting point to raise here is that we are still in a fairly rising market, Juliet, and obviously to many this was a surprise last night that both headline and COMIN have actually kind of come in lower or in the line with what market was actually anticipating. We are still not out of the woods, and obviously Fed pricing further declines or actually keeping the rates on hold at the moment is something that everyone will be watching quite closely, especially given the fact that obviously bond market and real markets are actually kind of been fairly bearish over the past 24 hours. In saying that though, I still think that at some point in the future we will actually get that interest rate hikes, especially if the Middle East tensions come out of the closet, and that's what's been happening over the past 24 to 48 hours. And if crude oil can actually continue heading higher, there should be inflationary, at least on the headline front. And as a result of that, we should see US dollar gain further momentum and break out of the falling flag pattern in a rising market. The uptrend is still fully in tilt, and if you can take out the prior high of 101.79, we should be heading higher later in the year.
Zoran, I've had two guests on already today telling me different stories about where they see oil go. What is the charts, or what are the charts telling you, particularly after that big 9% spike on Monday, which was the biggest one-day spike in 6 years?
Yeah, buy now, pay later. That's what it's telling me at the moment. If I have a look at the, crude oil, obviously we've got a lot of disruptions happening over the past few days, or in fact, actually probably over the past few months. Oil is one of those ones that's actually been very, very inflationary. And, that backdrop of $68, if looking at the technical charts and basically that gap that was closed from February 27 in 2026 is actually a bit of a perfect playbook, Julia, when looking at the technical analysis, because in technical terms, we generally tend to say that gaps do get filled and markets do retrace. And on the back of that, that's exactly what we've actually seen here. From that one in 1978 back in March, April, when the war broke out, we saw nothing but a sideways market in crude oil, and actually somewhat actually dropping out of that range of $84. Now, what we're seeing as the last major range in the market at this point in time, we're actually seeing that risk being priced into the market, or exactly what's happening in the Middle East. And on the back of that, we're actually seeing the demand coming and getting picked up by the traders and investors, both in the futures market, in the options market, and also on the spot market as well. So if you ask me personally, I'm actually very, very bullish on crude oil. I think the $68 was actually kind of a backdrop and solid foundation. I think there is a lot more orders being worked into the market, and my first level of resistance is around $85. If we can break that, then we should be pushing higher up towards the downtrend line from March highs of $119, which is in the blue dashed line that's on the chart. And that's anywhere near the $92 to $94. Obviously, a lot of this will depend on the geopolitical risk that's been playing out. There is no consensus at the moment. It could easily be a taco from US President Donald Trump. They could come back to the negotiations table, and if they do, then obviously we would expect crude oil supply to actually kind of drop off and market to retrace. But as things stand at the moment, it's looking fairly bullish, I have to say.
All right, Zoran, tell me what's happening with silver. It was sort of a hot commodity towards the end of last year, but sort of faded away a little bit this year.
It did. It's kind of following the trend of what gold is doing as well. So we can actually kind of replicate the charts, Julia. If you have a look at the gold chart, if you have a look at the silver chart, and if you also have a look at the actual crude oil chart, it's to some extent actually very, very similar. But what we're seeing right now is kind of a sideways consolidation on both fronts, and we can actually see that some of those levels are yet to be broken. So silver is ranging around that $58 to $60 range. It's got a downtrending dash line that's kind of hugging the trend. It's broken through all the 20, 50, and 100-day exponential moving average. So it is within the niche sort of range at the moment. And now we actually are waiting to see whether it's actually going to break to the upside or downside. If we get the inflationary global demand into the market, and global central banks continue being more hawkish towards hawkish tilt as opposed to the neutral or bearish, then we can expect the US dollar to kind of pick up. On such basis, I would expect gold and silver to come off. And that's exactly what we're actually seeing. It's a bit of an inverse conversion to the US dollar. However, not to say that we can't get a repricing of the market and silver, can't actually go upwards from here. The key levels that I'll be watching as a trader is towards downside, towards that $45. I think that's a bespoke support level that can hold for at least certain amount of period of time. On the upside, I'll be looking at $68. As long as silver can actually hover within that range and consolidate, then at some point in the future, it might gain a bit of momentum. But right now, it's looking a little bit more bearish than bullish, I would say.
All right, Zoran, always a pleasure. Thank you so much. Zoran CoreCivic there from Blueberry Markets. That does it for this edition of The Trade. Be sure to join us next time.